This week, we're diving into tech buybacks and why they're back in a big way. The top 20 companies in the S&P 500 now account for more than half of all share repurchases. And we're not just talking small fries here. Q1 alone this year saw nearly $300 billion worth of buybacks. So, what's fueling this frenzy? Well, by the end of this, you'll know exactly what's behind this resurgence, who's actually creating shareholder value, and when a buyback is more smoke and mirrors than it is smart capital allocation. And of course, if you want to go deeper into the numbers, graphs, and company breakdowns, you'll find the full article linked to in the description. All right, let's get into it. Once upon a time, believe it or not, share buybacks were actually illegal. Before the SEC brought in Rule 10b-18 back in 1982, buybacks were considered a form of market manipulation. But fast forward to today, and buybacks have become one of the most common and tax-efficient ways for companies to return cash to shareholders. The logic is pretty simple. Fewer shares means higher earnings per share, which can support the valuation and signal confidence in the company's future. But this momentum hasn't always been smooth. Buybacks slowed during the pandemic, then rocketed to a record high in 2022. A year later, the brakes slammed again, down nearly 14% year on year in 2023. Why? Because the capital was being redirected into areas like AI and infrastructure where returns take time to build. And it appears the tide is turning once again. In early 2025, companies came roaring back. Q1 alone saw $293 billion in buybacks. Communication services and tech stocks led the way, up 56% and 26% respectively from the prior quarter. In August, the poster child of the AI race, NVIDIA, announced a jaw-dropping $60 billion buyback program. So why is there a resurgence? First up, they're flexible. Unlike dividends, buybacks don't lock a company into a recurring commitment. You can do it once, or not at all, the next quarter. Then there's the tax advantage. Dividends are taxed as income, but buybacks not until you sell the shares. Also, slowing core growth is playing a role. When reinvestment into bleeding-edge tech like AI takes time to show results, companies often pivot to more immediate ways of keeping investors happy. And let's not forget shareholder pressure. From institutions to individual investors, the push for returns, especially from cash-rich names, is pretty loud. Apple, Alphabet, Nvidia have all got fortress balance sheets and piles of cash. And when valuations dip below perceived fair value, buybacks can be a very tidy way to deploy that capital. But it's not all roses. There are risks too. You see, here's the problem. Just because a company can buy back its stock doesn't mean it should. One of the biggest dangers is opportunity cost. Repurchasing shares might lift earnings per share in the short term, but if it comes at the expense of reinvesting in high return projects, like for example AI infrastructure or next-gen semiconductors, it could backfire longer term. And when buybacks happen at elevated valuations, that's just another red flag. Overpaying for your own stock using shareholder money is not capital discipline, it's really bad math. Senator Elizabeth Warren is not a fan of the practice. As she put it, buybacks are often used to pump up the price of your shares by using your own cash, not investing in the business. The other downside is less cash for dividends. Once upon a time, dividend yields sat comfortably between 3 and 6%. Today, though, they're below 2%. Oh, and the whole thing is incredibly concentrated. The top 20 companies in the S&P 500 account for more than half of all buyback activity. That makes this wave unusually dependent on just a handful of mega-cap names. So, how can we investors separate the value creators from the headline chasers? Well, not all buybacks are created equal. Smart buybacks start with strong free cash flow. If a business like Nvidia is generating healthy, recurring cash flows, then yes, it is in a good position to consider returning capital through buybacks. Low debt matters too. Companies that borrow heavily just to fund buybacks may be stretching themselves too thin. And consistency counts. One-off buybacks can be flashy, but a consistent yet disciplined repurchase program where valuation matters shows real commitment to shareholder value. And one final thing to watch is stock-based compensation. If a company is issuing loads of new shares while buying back old ones, that can wipe out the benefits of the buyback pretty much altogether. So keep an eye on the net impact. If the share count isn't shrinking meaningfully, the buyback might be little more than financial window dressing. So what's the insight here? Well, buybacks can create shareholder value, but only when the fundamentals support them. Buybacks can be a powerful signal of confidence, but only when backed by strong fundamentals, executed at the right price, and not used as a substitute for real business investment. As Warren Buffett himself put it, the best use of cash, if the stock is underpriced, is a repurchase. At Simply Wall Street, we've built tools to help you figure out when a company's buyback actually makes sense. Our screener, Tech Stocks with Buybacks, highlights 19 companies with high buyback yields that are also trading below their estimated fair value. You can save that screener and tweak the filters however you like. Want to check if a company is generating enough free cash flow or is carrying too much debt? You'll find it all in the financial health and past performance sections of the company report. And if you add the stock to your watch list, you'll get notified about any buyback announcements or new share issuances, so you never get caught off guard. And that's where we'll wrap up this week's Market Insights. So while tech buybacks are back in a big way, the smartest investors won't just follow the headlines. Make sure you look under the hood and ask, is this boosting long-term value or just dressing up the numbers? If you'd like to dig deeper into this trend, check out the full article, which is linked to in the description. As always, we'd love to hear your feedback, so let us know if you have any. And we'll be back next week with more market insights. But until then, invest well.